welcome to the Australian's Money Puzzle podcast. I'm James Kirby, the Wealth Editor at The Australian. Welcome aboard, everybody. Well, you've probably been watching and noting that change of tone in the markets and investment markets in recent weeks. It's the sense that perhaps these interest rate cuts that we all thought were coming down the line are going to come down the line, but they may not come down the line this year, folks. It could be some time. See some of the big names in the market, Jamie Dimon Citi this morning, actually saying the same thing. So you're getting that sort of caution all around the world that rates may stay where they are. And what does that mean for property? What does that mean for your plans in property? I want to look at that today. I want to look at a number of key issues in property and property investing. And I'm joined by an old friend of the show, Dr. Doug Turek. Hi, Doug.
Hello, James.
How are you?
Terrific, thank you.
I should have mentioned who you're from. Minchin Private Wealth. Have I got that right?
That's terrific.
Lovely. I nailed that almost. Now tell me, so if the rate cuts don't come this year, and every time I see someone forecasting when the rates will come, they seem to push it out a little bit further. Yeah. Further and further and further. I mean, they're talking about November, December now. Hey, that's the end of the year.
It's almost like that recession that kept getting pushed out further and further.
Yeah.
And now we don't think it's coming. And in fact, we worry about inflation being sticky, which is why this, drop down in interest rates that's been foreshadowed, particularly by Jerome Powell in the U.S. Late last year, may not be coming. There's a lot of pressure on him because the banks would love some interest rate relief, as well as the U.S. government would love some interest rate relief.
Why? Why would they like it?
Well, the banks during the COVID crisis bought a lot of government debt, and it's sitting on their books as a giant loss. And there's been an engineered scheme to try to, with accounting, to make that loss not look so bad.
Right.
But they would welcome that the size of that loss reduces if interest rates go down.
Okay.
And, the U.S. government is running an enormous deficit, which is very unusual for peacetime. And their interest rate costs are now, I think, their largest outlay. And that puts a lot of pressure on the U.S. government. Now, while central banks are supposed to be independent, the Federal Reserve is owned by the banking system in the U.S., and also all central banks are beholden to the country governments to help them in difficult times. So there's pressure on reducing interest rates. On the other hand, services inflation seems sticky. And we as consumers see that every time we go to a restaurant or buy services.
Absolutely.
And that might suggest that the promised rate cuts aren't coming.
If you're sitting here as a property investor, then you say, well, if rates, there's this sort of perversion to a degree in the markets in terms of the way that people think that, there's more people unemployed, and so that's good news because that will push rates down. But really, in the real world, very low rates often signify a dead or dormant economy. And so it's not necessarily a bad thing, is it, that the rates are where they are or stayed where they are economically?
I agree. And rates are probably close to normal. And what we had was an abnormal period that drove property prices very high. So then the question mark is, is gravity going to work and pull them back down? But property prices are even more sticky than cost inflation.
No, I don't think we were talking about whether they'd drop. Maybe if you think they're going to fall, let me know. We've had very few people say that. Stephen Koukoulas was on the show a few weeks ago, and at that time he thought there was a distinct risk, particularly if unemployment rose in Australia, that they would fall. But I suppose the first lap of that particular race is, do you think that the property market has had its run for the year because people were expecting rates to drop and now they're not going to drop in the time frame they thought?
Yeah, well, many commentators have failed trying to predict the short-term movement of property prices.
Sure.
So, all one could say is
the
might or
road
maybe.
Is littered with them.
Indeed.
Yes.
And you probably remember 2 years ago there was quite a unanimous view that property prices were going to fall from 5 to 10, and they didn't.
Yes, indeed.
So, I don't think you and I are going to be able to be confident in any forecasts, but I think we can say that we live in a very financialized world now where movement of money is probably more important than fundamentals.
Okay.
But property prices on the long term keep creeping up because the cost of replacing properties is getting more and more expensive.
And there's nothing being approved.
Uh,
I don't mean to be facetious, but building approvals are actually going backwards, which is just alarming, isn't it? Really,
That's
in the
right.
context of
Yeah, so over the very long term, replacement cost of buildings does, put a bit of price appreciation into the market.
yeah,
Land is scarce; we're not building any more of it, and the purchasing power of money is weakening, as we have been observing. So, the
Yes.
trajectory for property over the long term is still healthy.
yeah,
It may be overstated by these factors, inflation particularly, but again, it is probably possible that things will stall if interest rates don't come down, and that would be healthy because there's many people out there on the other side saying housing affordability is terrible, and how
Yeah.
do we get our children into the property market? So
Yes.
having a pause is reasonable. We probably did overshoot in property prices when interest rates went to zero, and
Yeah.
mortgages could be had for 2 to 3%. So now they're up at 7. It's actually quite unusual. Property prices haven't come down. So the most logical thing is that property, almost to adapt to that period, should go sideways for many years. So
Okay.
rather than just 1 year, maybe barring a burst of Argentinian inflation, property prices might go sideways for 5 years, might go for the rest of the decade.
Well, what would sideways be in numbers? If inflation was 4, say.
Well, we already had inflation, right?
Yeah.
Our property prices probably overshot double, triple inflation since around 2020. So we've
Yeah.
had 3-4 years of too fast property prices. So we don't need to have any property price
Yeah.
increases for the next few years. That would not be unusual.
You're not saying that's what's ahead of us.
Well, that's one scenario,
Okay.
right? So
Yeah,
because there are so many factors that stop property wanting to fall, banks don't want to
Yeah.
foreclose, governments don't really want tax revenue base to fall. There's a lot of factors that will see property stay flat rather than fall. But one could argue once interest rates have gone from 3 to 7, property prices should fall down. And we
Yeah.
saw that in the commercial property market. If you
Yeah.
own a REIT,
Yeah.
your REIT came off 25%, but it probably went up 40%
Prior.
during that period when interest rates. So property.
So can these things be contained? People say, okay, so there's property trust not doing very well. There's particularly office trusts, office-based REITs, industrial property, but certainly commercial property in the major cities. There's a vacancy rate of 30% out, not far out that window on St. Kilda Road, which is extraordinary. That's like deep recession vacancy rate. There is property builders, house builders going bankrupt every other day, small ones, but and some big ones I expect basically being kept alive. But can that be contained and residential property keep ticking along if those problems are there in tandem?
Yeah, so commercial property, we probably should say, are we talking about property that's bought and sold in the share market every day, which some of our listeners do
Primarily,
through real
yeah.
estate investment trusts?
Yeah.
They're dynamically priced and they have corrected. In fact, James, they've actually gone back up in Australia because, the appeal of 5-6% yields with some built-in long-term inflation protection was too good to give up. I mean, I think REIT prices came off about 25% in Australia last year, and they're creeping back up. Unlisted property, on the other hand, which residential property is, as well as some of the commercial properties that's hidden inside a giant super fund or unlisted fund, maybe we might have some concerns around whether their valuation has been marked down enough to reflect this scenario. So,
Right. Yeah.
So that we may be in a scenario where we're comparing sort of unlisted property, and one could argue there's a bit of a seller's strike going on with residential property. Sellers are not willing to, give away the property at a lower price, which might be fair for a higher interest rate environment that we're in.
Right.
So I think we're not seeing a great volume of sales, and I believe buyers are struggling to find property to buy. So the few that want to buy, because they're at that house formation age, they're having a young family and they're making good money, maybe dual income, and the bank of mom and dad's lending, they're struggling to find supply, so they're having to pay top dollar. So there might be some artificial factors that are holding prices up.
But there are factors nonetheless that hold the prices up. But there's always artificial factors in the residential property market.
Yeah, but it might be another reason to explain why haven't residential property prices corrected substantially owing to the reduced purchasing power of people through inflation and the doubling of the cost of borrowing.
I suppose it's also an argument as to why they'll stay where they are, at least. If those factors remain in place, the shortage of property, the shortage of stock, those issues aren't going to go away tomorrow.
Yeah. Or put another way, unlike the share market, the property market doesn't like going down. You need a lot of disruption to drive property prices down.
Not as many shorter residential funds that we are aware of, at least.
You need, unfortunately, job losses. You need people who can no longer service their debt. Now, it may be that people are sitting. Maybe this is a lag effect going on, and maybe there is that drop in property prices coming because people are just running out of savings. There's evidence overseas, credit card debt's rising. The consumers aren't coping. It's just they've had some buffers that were probably enlarged through the COVID stimulus.
Yeah.
And maybe we're coming into this period where it's unable to afford a mortgage, and we might start to see some forced selling. So anyway, I think that going back to your original question, would we see property prices stalling? Again, with the caveat that no one's good at these guessing, I would have to say yes.
Okay, very good. We might just leave the first segment there, folks, because it's a very interesting way to think about the market and some of the signals we're seeing. And as you mentioned, the buffers are being worn down for sure. The savings rate, for instance, has come off completely back to the levels that we were traditionally used to. All right, we're going to take a short break, and we'll be back in a moment with a range of terrific questions that I've selected specially for Dr. Doug, because they are the sort of questions I think that we need an experienced advisor to answer. Back in a moment. Hello, welcome back to the Australians Money Puzzle podcast. I'm James Kirby, the wealth editor at The Australian, talking to Dr. Doug Turek of Minchin Moore Professional Private Wealth. Now, there is a piece of correspondence from Billy. This is basically what he's saying. You've mentioned in Victorian property prices have not grown as strongly as they have in other states, and you also suggested this is due to the new land tax regime, and I agree that this may be the cause. While acknowledging that the new land tax has a negative impact on investors, I think it's also valid to say this new land tax is a positive for young families who are trying to buy their first home. I would not be surprised if we see other states making similar changes. It might even be a vote winner. Billy, I don't disagree with you for one moment that it might be a vote winner with the particular demographic that you are bending over to please. However, there's no sign of other states copying them, and Queensland did flirt with the land tax and pulled away from it, another Labour government a few months ago. So I don't know about that, but it's indisputable that pile on the land taxes, the market cools, it's cheaper for people to buy their first home. Yeah. True or false?
Look, it could be, but I always worry encouraging governments with putting tax on assets, and where does it stop? In this case, I think what we're talking about maybe is the vacant residential tax, which is a second asset tax that sits on top of land tax.
That's right, and a whole bunch of new taxes.
And it's being expanded outside metropolitan Melbourne, and it will catch people with holiday houses. I think it may even catch people who own them through family trusts, unless an amendment comes through. And it's quite a punitive tax. The state governments are very reliant on property-related tax revenue, and they do all kinds. It's not just investors. If you look at first home buyers, they're paying much more in stamp duty. So property is an immovable asset, and therefore it is more vulnerable to this legislative risk of tax.
Yeah.
But there are some good arguments made by Billy around the trade-offs between incentivizing landlords to make property available for renters versus the tax code, and does it advantage homeowners?
Yeah, there's some WA have done a little experiment basically about rewarding people who take properties off Airbnb and putting them back into the market. So as you say, you can do it both ways. And the other thing I would say to Billy is that at a certain point the states will start to compete, and one state will say, "Hey, we'll become the here's the state to buy property in," and they may well have a competitive advantage if they did. Okay, there's a question from Pat. Would you like to read that one, Doug?
Yes, so Pat is retiring and has minimal super, but is selling a property and plan to transfer as much of the proceeds as is allowable to an industry fund over the next 10 years till I reach 75. So we'll assume Pat's 65. And in the meantime, in the taxable environment, I will be looking for a diversified funds that behave similarly to a large industry super, with not just shares, but also property, private equity, etc. Can you suggest the top three, please?
Yes. Sorry, Pat, we're not going to suggest individual funds to you. However, you know how the industry funds work, and you can see in the My Super tables how they work and who's performing better. It's not hard to find out, to get some comparisons. In funds management, you could look at Morningstar, for instance. You could look at some of the other services, Super Ratings. They also do. There's another one. It'll come to me in a moment that they do this comparison of funds. The issue was that the fund that was really good last year may not be the fund that was will be really good next year. And they aren't really comparable, are they? The funds that are available outside super, these powerhouse industry funds that are institutionalized, that are baked into the system, that have the compulsory guarantee of making money flow in the door, and they can operate in a very different way than most funds.
Yeah, so the industry has evolved. So many years ago, mom and dad investors outside super would have access to a range of what we call multi-asset funds, which is what I think Pat is intending to put his super into. But those funds in industry superland, we might almost think of them as a bit endowment style, and they do a lot of unlisted investing, maybe up to 30%, and
with
some very
serious long-term.
That's right, some very sophisticated strategies, which probably are too sophisticated for an individual investor. So the solutions Pat has available are more simplified multi-asset funds, and the traditional active style or more complex multi-asset funds have fallen away out of disinterest as Australians have become single sector investors. We love ETFs. We like to have our Australian share fund ETF, and we want to have a high dividend version of it, or we want to have a high growth version. We want to have a NASDAQ fund. So Australians now love piecemeal investing, and they can do it through democracy of ETFs. So it's very uncommon to find a multi-asset fund left. There are ones from the two largest index suppliers, but if you look inside them, it's not going to achieve what Pat wants, because they're just going to allocate to public equity and public bonds.
To listed securities.
That's right. So if you want to get private equity, there is on Australia one, I think, ETF that buys private equity.
So you have to build it himself.
He'll have to build himself, will be one thing. And look, the other thing to just point out is a reminder to all the listeners to try not to be Pat. Now, maybe Pat did terribly well, sorry, Pat, in building this great property portfolio, but he built it outside super. So now we have this 10-year journey of shifting assets from a taxed world to an untaxed world, and poor Pat's going to pay 25% tax on his capital gains. Now, if there's a way you can build all of those assets in super earlier, you're going to, pay no tax or maybe only 10% capital gains. So the problem, of course, is Pat and others probably built their property portfolio with gearing, and that's a lot harder to do in super. But just one thing for the listeners who aren't in Pat's exact situation, just a reminder, super is a great destination tax structure. Property doesn't always lend itself, so this is not an uncommon thing. But there are generous contribution caps still around, and if Pat is married to Patricia, then a couple could probably put $1 million in super in the next 3 months
with catch-ups and everything.
Well, we can put in $110,000 each in the next few months.
This is post-tax.
Post-tax, and then we can also put in $360,000 each as a couple. So that's $720, add another $220, and we can probably put in $27.5 to defer some of the capital gains this year, and we're going to sell another property next year. Add all those up, the non-concessional, concessional contributions, that's $1 million that can get into super. If Pat and Patricia are selling a primary residence, they can add in another $600,000 using the downsizer. So it's possible to get $1.6 million of money quickly into super. But if the property portfolio is substantial, there's multiple properties, yes, it will take some time. An interesting question for Pat is, since we can't find an industry super fund that invests outside super, and Host Plus experimented with this but then shut it down when it found people were gaming a little bit of the pricing of its infrastructure and property assets that it made available to the non-super investor. do you want to invest identically? Do you want to, if you really hate paying tax, then maybe outside super, you should be investing in frank dividend companies, and you should be owning bank hybrids, which pay tax shielded income. So should you have the exact same investment strategy inside super as you do outside super? Because super is a terrific place to, double your money on NVIDIA.
It's a very different context.
So
that's really interesting. I want to pick up on something there. And that's what you're saying. It's really interesting. So, and I was sort of alluding to that, but you really sort of articulated that notion. I was saying there isn't really Oz supers and host pluses and C buses out and about outside of super. But, and then you made the point that even if they're very good, they can only buy listed securities, which makes me think of something that we get a lot of coverage and people pay a lot of attention to the big names in super, the big stars and the big industry funds. Mark Delaney, Australian Super, for instance, came out this week and he said, it's what he says is entirely correct, but I want to ask you whether it makes any sense for people, everyday investors, whether they may be misled even by something like this. So he came out and they said, they always say to these guys, what's the best investment at the moment? Or whoever is running, male or female. And he said, the best investments at the moment are private equity and infrastructure, which is true, I don't doubt, for him. But is it true for everybody?
Well, if I had to pick my favorite retirement asset class would be infrastructure, and we can buy that through listed means. But unfortunately, every time Sydney Airport gets taken over,
less and less of them, Doug.
And justified, it's a peculiar thing. But you often private companies often try to list on the share market to get an uplift in their valuation.
Yep.
But these infrastructure assets are so sought after.
The Canadian pension fund comes along.
The Canadian, the Australian, whatever pension fund
again and again.
actually will pay more for it than what a private market does. And then on their books, they keep pricing it up. So we have some, question marks over the valuations. But
so
anyway,
we lost Sydney Airport, as you said.
I would agree that, I love infrastructure because of its inbuilt inflation protection. And I believe that inflation is the number one enemy of the self-funded retiree. So that asset class. Private equity is an interesting one. We were looking at private equity for a family office I help with, and the solutions available to them from a very popular fund was to pay 2% every year and probably get, maybe if you're lucky, double your money back in 7 to 10 years.
2 and 20 or just 2?
2 and 20. So the interesting thing was the 20.
You might explain how that works.
Yeah, so every year 2% of your capital is paid away in fees, and also 20% of the return. Not the return over a benchmark, but 20% of the return is also taken away. So if you're investing with someone for
of any return,
yeah. So if you're investing for 7-10 years, well, you've got 7 or 10 times 2%, and that adds up to about 20% or 15%, and then we're going to lose 20% of the return. So if this fund only generated a modest 15% return for private equity, about nearly 5 of that's going to the manager and 10's going to the investor. So private equity is the last bastion of very high fees that we no longer see in public markets. I mean, speaking of infrastructure, you can buy an ETF that will buy you infrastructure all over the world for 0.18%.
Yeah.
But for 10 times that annual fee, you can invest in private equity. Now, the big super funds, as you point out, can invest with more buying power.
Yes.
And the other thing we know about private equity is, at the moment, looking backwards, the better fund managers perform and the poorer fund managers underperform. So the interesting question is, by the time a private equity fund manager comes to see James Kirby, how do we know that he's a good one?
By the
why
time
didn't
they're
he
that
first go
desperate.
to the Harvard Endowment Fund, and why didn't he go to Australian Super?
That's right. By the time they have combed the market so thoroughly that they're at my door,
so,
you say, why? You must be in trouble. What's the old joke? Your career must be in trouble if you're talking to me. Is it a variation?
Yeah, that's right. Almost Groucho Marx-like. Yeah.
Okay, well, look, we'll leave it right there. But on that issue of private equity, I think that was really good, and it was worth telling people that aspect. And the private equity fever that's out there at the moment, I feel, is entirely driven by private equity managers. And I am downright skeptical of their fee structure, and I'm also terribly concerned for what I would call late to the party investors, where a lot of the
So
good deals
if
have
you're
gone.
entering in this space, you want to be very careful. You're not the exit mechanism for a whole bunch of people who want out right now. There's actually a blockage in the private equity pipeline.
And there's no IPOs.
The money's not coming out. In fact, I
yeah.
read the other day that the number one way private equity money came out last year was selling itself to other private equity.
There you go. Oh, yes, we laugh, but it's true. Okay, we'll take a short break. Back in a moment. Hello, welcome back to the Australian's Money Puzzle podcast. I'm James Kirby, wealth editor at The Australian. I'm talking to Dr. Doug Turek of Minchin. We've been talking, and I think that was a very interesting stretch on private equity, folks. You've probably heard me a couple of times have a go at this issue. I've been trying to basically needle out what's wrong with it, or what's potentially wrong with it. And I think in that segment with Doug, that last segment actually captures a lot of my concerns around it. Okay, I'm just going to read a comment. It's from Quinton. And if you recall, we had Matt Barry of Freelancer
Terrific.
in the chair the other day on artificial intelligence, which he is entirely besotted with at the moment. He gives this terrific presentation, which he's going around the country with. He is still CEO at freelancer.com, and that's a $100 million operation. But he was really good on what it might mean for investors, for everybody. And in the course of it, I mentioned a story talking to about how my son and his girlfriend were so comfortable with the fact that the surveillance economy has become to a new level, that they were suggesting to me that when you go to, if you want to go to travel somewhere and you want to go to Bali, then if you want to get the best deals, don't mention the fact that you want to go to Bali in front of your phone or your device for a week or two, because if they hear you and they pick it up, you don't get the discounted fares. This is, I thought, mildly Orwellian, very Orwellian. But what I thought was most surprising was they were entirely comfortable with this. They had thought it through, they had assumed that was the case, and then they had moved one step ahead. So, Quinton says, irresponsible of Matt Barry to state as fact, clearly your phones are listening to you to feed into ad engines at the 26-minute mark, folks, Quinton says on the Matt Barry podcast a couple of weeks ago. And basically, Quinton disagrees entirely that this could be happening and says it's nonsensical. Now, Matt Barry isn't here to defend himself, but I think we'd have to go much deeper into it, Quinton, to see who was right and who was wrong, or who was more right and who was more wrong. I doubt it's nonsensical, though. What do you think?
I have a tin hat in these things, James. And
What's a tin hat? Pray tell.
I'm all for conspiracy theories.
Oh, are you? Well, we're we are not into conspiracy theories here at all. We want to absolutely wipe them out. But why does it happen so often that these things pick up?
Well, I think I read a somewhat scientific article that looked at the communication your iPhone is doing when it's sitting on the table and you're not talking, and it's speaking nonstop. It's telling someone where you are, and it's not fanciful to think it wouldn't be rebroadcasting what we are saying as we speak.
I think he told a story, I'm just remembering now, about how he dropped his iPods, out of his ear, and was probably scrambling around the ground, probably cursing, looking for them. And when he went back and went online, it was lost your iPads, and certain deals.
Well, I also remember in the Snowden movie, the first thing he asked the journalists, the James Kirbys, who met with him in a hotel room, is put your mobile phone in the microwave, please, because it's shielded.
Yeah, right. Is that right? Yes. Or if you think about the WikiLeaks movement and Julian Assange, they didn't use technology that much. They used the postal service. Because they were trying to keep so tight.
Well, we can link this to finance. I was listening to Mr. Dr. Doom from Thailand.
Mark. Is he still out there dooming away? Dr. Doom, yeah.
He is. And I heard this morning that he even suspects that Bitcoin was actually a government invention. perhaps to track finance flows around the world. But
right.
anyway, so he's got a full-on tin hat.
Anyway, Dr. Mark Faber, we're drifting. Okay. But all very interesting, and we could look, Quinton, we could have a full-on debate on that. Maybe we will. I have some ideas on that front, which I'm thinking about just now. Okay, another question, a final question from Scott. Do you want to read that one, Doug?
Yes. Hello, James. I bought a house in 2003 and moved in. I moved out in 2005 and rented it out. In 2006, I moved back in. And then in 2009, I moved back out and have been rent vesting from then on. Question, as I've never returned and never will, do I get a CGT exemption for those 6 years from 09 to 15, even though I never went back or never sold within those 6 years?
Yes. And by the way, Scott and everybody, this is never advice, of course, on the show. It's information. And I have sort of regularly on these sort of questions, I've said, look, you just keep a diary as to when you were renting or when it was your primary residence, and you make that very clear to tax. And if you have a diary clearly on that, you can.
Yeah, so I mean, of course, the right answer is work this out with your accountant. But just a refresher for the listeners: the Australian Tax Office gives us an exemption from paying capital gains tax on our home. We call it the main residence exemption, and it also does that if you happen to rent out your home for up to 6 years.
The 6-year rule.
It's called the 6-year rule, and you can imagine if James gets posted to Darwin to become the finance chief there.
A strange career move late period, yeah.
And as long as you come back within 5 years and go back and live in the suburbs here in Melbourne, then we'll forget about that period for capital gains tax purposes. And so James, who bought the house in 2003, moved out in 2005, went back in 2006. That 1 year of rental can be forgotten from a capital gains tax perspective, provided at no time did James ever have another primary residence or main residence. You can't double dip, but as a rent vestor, which was a phrase he used, you don't double dip. You've bought, you're renting while you're also investing. So the key thing is you must first occupy this property as your primary residence at its start. Then you have all this flexibility of going in and back out. So if you're in and back out within 6 years, that appreciation during that 6-year period can be forgotten. That's terrific. Now, what Scott has said is, however, he moved back out in 2009, and here we are in 2024. That's 15 years. And so normally you'd say, well, that's longer than 6 years. You get nothing. But if you have a look at the website of the tax office, and there is an article there called Treating Former Home as Main Residence, and there's a bullet called What Happens If the 6-Year Limit is Exceeded. The answer for Scott will appear.
Okay.
And it largely says that you can get a prorated portion. So in other words, of the 15 years, it's quite possible 6 of those 15 would still enjoy some capital gains tax appreciation.
Right.
It'll be prorated. It'll be prorated based on the value of the property back in 2009, hence your comment about keeping a bit of a logbook. And you need to know what the value is when you've started this new rental period.
Okay.
And that's my reading of the ATO website. And it's along the way, as long as Scott never had another property as his primary residence.
Okay, terrific. I hope that's useful to you, Scott, and all the Scots out there who are moving in and out of their homes and at the same time trying to optimize their tax situation, or at least clarify their tax situation. And as I say, always information only, not advice. Okay, folks, that was terrific. Thank you very much, Doug Turek and Minchin.
Always a pleasure, James.
Great to have you on, and great to have you accompany on the show. The email, themoneypuzzle@theaustralian.com.au. Talk to you soon.